Hello everyone, my name is Anomaly. Thank you for tuning in to another video for from the $5 Journey channel. Check me out on Facebook at the $5 Journey. That's the book. I'm the writer of the book, Anomaly, also known as John. That's my real name. Also you can catch me on Twitter at Anomaly 197711. All right, that's Twitter. And also, if you have any sort of suggestions, any sort of things you want to talk about, I'm always good for a good brainstorming session, so you can contact me. I'm at anomaly1977 at outlook.com. That's anomaly1977 at outlook.com. Today, we're going to talk about mutual funds. But first thing, I want to just say Merry Christmas to everyone who celebrates Christmas, and Happy Holidays to everyone else. It's always a great time of the year. You can hopefully spend some time with family, friends, get some good laughing going on, get some good entertainment going on, and really just a time where, hopefully everyone's able to appreciate all the wonderful people in their life now, and maybe, wonderful people that were in their life at some other point, But today, it was interesting because I was actually having a discussion with someone during some, food and laughter and everything going on. And they were asking me about my portfolio, and, I started talking about some of the mutual funds, some of the different things that I was involved in. And then someone else that I was also sitting with who was kind of, tangentially in the discussion, said, well, let me just explain what an actual mutual fund is to the other person. I said, and I felt bad. I felt convicted, actually, because I said, man, here I am spouting off about mutual funds, and the person may not even know what a mutual fund is. So anyways, I said, well, you know what? I've used the term a bunch of times in dealing it with the $5 Journey, the actual book, but also with the channel as well. So I want to just take just a few minutes to really briefly explain mutual funds. So if you remember in the $5 Journey, what I was saying is you get that $5 per day, or maybe more, hopefully more, but you at least start off with that $5 per day, right? And you're going to invest it into a mutual fund, right? And there were a couple of different companies that I was talking about. One of the companies I listed was Acorns. I believe the other one was Stash. There's another company that I've gone with also is Betterment. That's the name of the company, Betterment, Betterment. All right, you can also get the app for them, and they work similarly to Acorns and Stash, a little bit different. They ask what your long-term goals are, what your goals are, what your plans are, and then they pick the investment track that they feel is best for you. So the investment track would be certain types of mutual funds, aggressive versus stable. Aggressive normally are our stock, things that will be connected to the stock market. So there's a chance that the interest rate will be higher than in something that is more stable, like bonds or something along those lines, which may give you a lower interest rate, but your risk is a lot less. Okay, so anyway, so Betterment does that kind of thing. I will make sure that I leave the links to Acorns, to Stash, and also to Betterment in the caption below, okay, after, once when you guys watch this video. So I wanted to briefly talk about mutual funds, okay, because those three companies, they actually put your money into mutual funds. So that $5 a day that you're going to be investing or more, you're going to put that into one of these mutual funds, which you can actually have, or one of these companies that manages mutual funds. So I wanted to briefly explain. Now, everyone's heard of probably stock before, okay? What stock is, and again, I'm not a financial advisor, I'm not a CPA or anything like that. I don't get paid to give financial advice. I'm just a person who's been investing for, a long time, maybe for about 20 years or so. And I've done some pretty good things, done some bad things also, obviously, which one of the things I talked about in the book. But I've also done some good things, so I have a decent amount of experience and everything. I'm not prescribing any sort of set agenda for you. Make sure that you contact a financial advisor or a CPA or something like that, so they can kind of elaborate on some of these other financial vehicles that I bring up. But anyways, mutual funds. So first we need to start with stock. So what stock are is basically it's a piece of a company. All right. So so let's say you have a company. It is, I don't know, maybe it's worth $100, and they give each piece they're giving away for $1. Right? So if you put in $1, that means, and there's 100 pieces, and each piece is $1, that means that you own 1% of the company. All right. So stock are basically it's ownership of a percentage of a company. All right. Now, what happens is you have these things called mutual funds, which are basically a collection of companies together. Okay, so now what do I mean by a collection of companies? All right, so here's a good example. So let's say you can have a technology company, right? Let's say you have 3 different technology companies. Let's say Microsoft, Dell, and HP, right? Could be Apple, could be Samsung, could be whatever. All right, but let's go Microsoft, Dell, HP. Okay, now you can have stock in Microsoft, you can have stock in Dell, you can have stock in HP, right? The thing is that with that stock, sometimes there are shifts in the market. Sometimes things go wrong, go right. When it goes wrong, what happens is the stock drops. When things go right, then the stock increases. Now, that's not necessarily always wrong or right depending on the company. Sometimes it may be other factors, like if there was some sort of virus, some sort of computer virus that really, hacked into these 3 companies, then it might cause a stock to plummet. All right. If there was an announcement about some sort of new, wonderful discounts on, these kinds of, electronic products or computer products, the stock may go up, so there's all kinds of things that can affect stock. All right. They can go up and down. Some of the things the company can control, some of the things the companies can't control. What a mutual fund does is it is a collection of, it is stock, but like a collection of companies and their stock. All right. And it has, you have a mutual fund, an advisor, it's a financial advisor. And what they do is they actually invest certain amounts of money or certain amounts of your money in these companies. All right. So for the technology company, you may have, let's say, what do we say, Dell, Microsoft, Dell, HP, right? So let's say you, as a person who's investing, let's say you want to invest in a mutual fund of tech companies, right? And so you say, okay, well, you go on your, let's say you go on your Stash application, right? And you see, oh, they have all these tech, they have a tech mutual fund that you can invest into. And then you go and you look and you say, oh, it's company A, B, and C. Well, definitely I want to invest in that mutual fund's portfolio, which a portfolio is kind of like a glance of what is in what a certain financial investment is made of, right? So in this tech financial investment, right, it's made up of companies A, companies B, and company C. So when you buy that mutual fund, you're getting units. You're going to buy a mutual fund with these 3 different companies. Okay, so units in these 3 companies. All right, company A, B, and C. Now you may say, okay, well, I want to get involved in a tech company, or I want to get involved in a pharmaceutical company, right? So a pharmaceutical company may have, Johnson & Johnson, Eli Lilly, may have Celgene, may have, any of those, Roche, may have any of these kinds of pharmaceutical companies. So let's say it has 3 pharmaceutical companies, right? And their stock, right? So it's a collection of, say, 3 stock. All right, so you invest in this one. Okay, so you may have that. Now, why would somebody want to use a mutual fund? Why not, you say, okay, well, Anomaly, if company A has stock that I can buy, and they tend to go up really rapidly and give me a great return on investment, why would I want a mutual fund? In your other videos, you said that mutual funds maybe give like 10% or 12% or something like that. Yes, that's a very, very good question. That is very true. Stock do have the potential to really shoot up, and give a 25% return or a 30% return or something like that. It doesn't happen a whole lot, but certainly it does happen often enough that if somebody just invests in one particular company, over the years, and you'll see a dramatic increase, right? What mutual funds do is, look at this. They spread it out over 3 companies in this particular scenario. Okay, so yeah, you have stock in company A, B, and C. Well, here's the thing. If company A, something happens, whatever, I have no idea. Company A stock goes down, but company B and C stock is going up, then now you've decreased your risk. So when you have the fewer companies you have, so if you had stock, you just do one company, right? So your risk is pretty great, because if the stock goes up, cool, great, wonderful, But if the stock plummets, if it really goes down, well, there's nothing really to help buffer the stock plummeting. So that's why mutual funds are a really good investment, because even if stock in company A shoots down, you have company B and C to help stabilize it, all right? And maybe A is going down really fast, and B and C are both going up. Right? So in that case, you would still come out. Very rarely is everything gonna plummet at the same exact time, right? Those kinds of things happen in recessions and depressions and things like that, right? But a lot of times, with mutual funds, you may see 1 or 2 assets, right? 1 or 2 companies going down, but they may have like 5, 6, 7, 8, 9, 10 different companies, okay? So that's one thing about mutual funds that I really like. The fact that it kind of buffers you against risk, because you're not just buying stock in one company, but you're buying a stock in a collection of companies, all right? So that's one thing. The other thing is the fact that you can actually, you can be a little bit more selective according to your needs on the type of mutual funds that you get involved with. So for instance, for Acorns, right? Now I'm 40 years old, but for Acorns, since I'm 40, I can still be kind of aggressive with it, right? Where, a lot of my investment, a lot of my money is tied up in stock, because they tend to go up. But it's spread out. It's still spread out over multiple companies, right? But I can still pick. If I was looking, let's say I had a decent amount of money, or let's say I was older, and I'm just kind of looking to get higher interest that the bank can give me, but I don't really need to try to really rapidly grow my money. I really prefer to just be stable and to have like little risk. Then I can pick one that's a slower growing one. I could pick like a moderate pace one or a stable one. Different companies have different names for it. So you can actually do that. If I want to pick a certain industry, right? Like let's say I'm really passionate about like I don't know, let's say building wells in Africa or something like that. There may be companies that have shares, right? And I can come across a company that will have mutual funds with these different shares, with these different companies, right? That concentrate on just building wells in Africa. All right, and I can invest in that kind of company. All right, and that company will hopefully be able to give me some sort of return. Let's say I'm passionate about technology. There may be companies, like HP, Microsoft, Dell, Apple, Samsung. There may be, all of these kinds of Whirlpool, whatever. There may be all these kinds of companies that are technology companies that I really enjoy technology companies. So let me invest in it. There may be companies. I know there's this one. I think it was with Stash actually. They have an investment called. I think it's called like Warren Buffett's or like the Buffett Investments or something like that. And basically, what it is, to my understanding, is it's the companies. It's a stock that Warren Buffett himself actually invests in, right? Has a lot of his assets tied up, a lot of his money tied up in. So they have a mutual fund that is a collection of those companies, all right? Does it do well? Yes, it does do well, all right? So again, that could be the other aspect. So number one is mutual funds kind of protect you, shield you a little bit against risk, right? Especially with market rising and falling issues. But then also you can actually pick out the type of mutual fund. It could be an aggressive mutual fund, or you can pick the kind of companies that the mutual funds portfolios consist of, right? Do they consist of blue chip companies? Do they consist of S&P companies? Do they consist of technology companies, pharmaceutical companies, social service companies? So you have that sort of selection. All right. So Acorns, you can pick like aggressive, conservative, moderate kind of thing, and it'll give you projections. With Stash, what you can do is you can actually pick different ones such as technology, pharmaceutical. There's the Warren Buffett one that I mentioned earlier. With Betterment, they ask you a series of questions to figure out what you want to do. What's your goals? What are your plans? Do you want to invest for for stability? Do you want to, why do you want to invest? All right, and then they kind of give you guidance on how to invest. All right, they'll once you say okay, you want your money to go in a certain direction, they do it for you, but they kind of they help to steer you. All right, so these are all good financial vehicles for new people, getting involved in mutual funds and investing and having a passive cash flow, a passive way of making your money actually work for you. All right, so that's one way of doing it. I know I've spoken about REITs. I've spoken about what else? I've spoken a little bit about annuities, right? Or at least I've mentioned it. So I think that really that's about mutual funds, REITs, annuities, obviously real estate. That's something that we'll get more into later on. But mutual funds is kind of what I just wanted to mention to you guys about today. So just to recap, these companies have stock. What the mutual funds is a collection of those companies and their stock, right? And you can invest in those. So normally the mutual fund has a per unit price. So you would buy a unit. Now, what happens is with a lot of these other companies, the reason that you're able to invest $5 per day, at minimum, is because they give like a portion of the unit for the mutual fund. Okay, so it may not. So let's say for this mutual fund right here, for this collection of companies A, B, and C, let's say a one unit is $50 to buy into, right? Well, what these companies, Acorns, Betterment, Stash, are offering is that you can take $5, right? And you may not have the whole $50 to buy it, to buy 1 unit of this mutual fund, but you have $5, and what $5 will do at that price of $50 per unit is it will give you 10%, 10% of a unit. All right, so so it'll give you 10% of a unit, and that'll still go up. So those are the things to keep in mind. Mutual funds, REITs, obviously, and some of the other financial vehicles that I've mentioned. All right, any questions, comments, make sure you leave them below. Thumbs up the video if you like it, subscribe, make sure you share the knowledge. I'm not getting paid for any of this stuff by those companies, Acorns, Betterment, Stash, but I want to make sure that you guys are able to actually benefit from it. So my reward is you guys get the knowledge. Hopefully it's broken down in an easy way that everybody can understand. I am working on a workbook. When I say working on it, meaning that it's in my mind to a degree, but I have not yet put it on paper. So that's going to be coming. Stay tuned. Pick up a copy of the book and let me know if you have any questions. All right, thanks. Have a really Merry Christmas. And, I'm sure I'll be talking with you guys before the new year, but just in case, have a happy new year. All right, happy investing in 2018. Come on, let's do it big. Take care.